21st Century Entrepreneurship with Martin Piskarik.
I try to get people to really second guess investing in the stock market as an excellent form of investment. People think that, if I'm going to invest, I put money in the stock market. I want to have them think about something else, and which can actually provide them a better return with less risk. And that's something that many people don't really understand. They think, okay, I'll put it in the stock market, maybe individual stocks, or I will put it in mutual funds. But there's a better solution, or at least an alternative solution. And we want to have them, think about that, because many people don't think about it. And the second thing is, when people think about real estate, they think it's too intimidating. They don't understand it, or they don't know how to go about going into real estate so they can actually make an income or build it for retirement. They don't want it to be something that they're going to have to keep putting money in. And the other big headache of managing real estate, people hate dealing with tenants. So can it be done without those headaches? And that's one of the things we can talk about. How do we do it? What do we do? PropTex is a real estate centric fund, and we're giving 11% consistent returns every year. And that's actually better than the stock market does, which, if people understand what the benefits are, because the average S&P return is only 9 to 10% per year if you look at 10 years, 20 years, or 30 years. So we've done our research, we know where they're at. And if we're able to give somebody 11% without the risk and it's collateralized by real estate, it's even better. There's a better investment to the stock market if you want to retire instead of just mutual funds. And then the other big question, the thing that I talk to my potential investors or clients is, do you have enough saved? We've done our research and it shows that almost 50% of the population, if they were to retire at 65, they will potentially deplete all of their retirement savings because the cost of living is so much higher today. So do you have enough saved, and do you have a plan? So what PropTex does is it gives them this plan. Essentially, we're giving 11%. That means if somebody puts even as little as, say, a couple $100,000 or say $500,000 into PropTex, in 10 years, that will almost triple. So that 500,000 will be, because it's compounded, that will become almost 1.5 million. And if you on 1.5 million, if you're getting 11%, you can live off of that. You're getting almost $13,000 a month consistently without depleting your savings. So that means you have more to leave for your kids and grandkids as an inheritance. So first of all, Martin, I just want to say thank you for having me on. I've listened to your show, and what you're building here is something really special. And I just wanted to acknowledge you for that, because I know that what you're doing isn't easy and it takes a lot of hard work. You're creating a real impact, and I'm honored to be a part of it. A little bit about myself. First, my name is Jay Patel, and I'm the fund manager for the PropTex funds, which are essentially designed for people who've worked so hard for their entire lives and now want to be able to look towards retirement, which means being able to do the things that make them happy without being concerned about money, or more importantly, worried about running out of money, should they live a longer life, as many are doing today, especially with modern medicine and a greater focus on health and fitness. And I've noticed myself that, as we get older, we begin to look inward. So for example, I'm 54 now, and I'm much more spiritual than I have been. I also realize that I'm not invincible. So I'm now focused more on my personal health and fitness compared to what I was when I was in my 30s and 40s. We also begin to watch what we eat or drink. And I'm also now planning more trips to countries around the world. Why? Because I recognize that the average person lives to be about 75 to 80, which means hopefully I have at least another 15 to 20 good years, right? Which I can do things and basically be able to do them physically without pain or assistance. And I don't want to waste that time sitting behind a desk as many years slip by. But the main issue that comes up is, do we have the money? And are we set? And that's really where I'm coming from, is that our focus at PropTex is making sure that we have the structure and a plan so that we can retire and enjoy our retirement. As an entrepreneur who has a company that maybe they're looking to exit or sell, they're going to have a nest egg. And what are they going to do? How do they manage that? Or corporate America, they've been working hard climbing the corporate ladder, and they're so good at what they do, but they don't have the time to understand or go research, investments or retirement and things like that. They're excellent in their own specific fields, just like business owners are great at what they do. But when they actually do sell their companies and have this money, where are they going to put it? Are they going to put it into the stock market, where it's a potentially, I feel, risky situation today? And the reasons for that is really because of the current economic condition. We've got rising interest rates, as we've seen, especially after COVID and what's happened. Foreclosures, for example, in the US right now, are up 18% in 2025 compared to where they were in 2024. And they're expected to continue to keep going up. And obviously we can go a little further into that, but there's a lot of reasons for that. The unemployment is climbing, which is, obviously it provides additional stress to the overall market. The S&P's 500 or the S&P 500 Shiller PE ratio is something that monitors the valuation of the S&P. Now, this is going to give you more of a macro understanding, okay? When we look at the S&P 500's PE ratio, based on the Shiller index, it's over 40. Now, what does that mean? That, to put this into context, the average should be around 18, let's say 16 to 18. Today, it's at 40. The highest it's ever been is 44. So what we're telling you essentially from this data is that it's really close near the high. So when things are near the high, what typically happens is it corrects. And if it corrects, it means that the market is more likely to come down. So my question to anybody who's going to be looking to invest is that the best place that you might be wanting to put your money? My argument would be no, because if we're looking at two different parameters, now we talked about, for example, foreclosures are up and they're going higher. If you have the ability to participate and actually benefit from that, wouldn't that be better than putting it into, say, the market, which could potentially come down because it's overvalued? And this is really kind of the thought-provoking concept that I want people to start thinking about, is whether it's their nest egg that they built in their 401ks, their retirement plans, their retirement accounts, or whether it's their big payday that they got from selling their company or selling their shares, or maybe they had a stock option plan, they sold out, and now they're looking towards retirement, or maybe in 5 to 10 years, what are they going to do with that money? And where are they going to put that? I'm not saying put it with us, but look at other things besides just the stock market. They may want to consider syndications, which are real estate syndications. The reason I bring up, PropTechs, why we're here today, is we provide a solution for that. And that's one such option. And if somebody's interested, they can always go ahead and check out the site. It's PropTechs, PROPTEX.com. And it's really just a real estate centric fund, which is investments that are backed by hard, tangible real estate assets. So it's not going to zero. And historically, real estate appreciates. Even though you may have cycles, like in anything, there's going to be cycles of ups and downs. You might have a situation where it goes down a little bit, but in the long run, real estate always comes back. And because there's a finite amount, right? I mean, it's not something that can grow. The earth only has so much, square footage or acreage, and the population is always growing. So as a result, the demand is going to continue to grow. And as a result, the prices are going to go higher. So if you make wise decisions, and what I always tell people, and I've actually taught real estate, what I tell people is you don't make your money on the sell. In real estate, we make our money in the buy. You buy it so smart that, your value is already built in. So even if the market were to correct, you're not going to take a hit. And that goes back to what I was talking about earlier. One person can look at the data that I gave earlier about foreclosure filings being up 18% in 2025 compared to 2024 and say, hey, that's gloom and doom. I look at that as a positive from my perspective in my business, because that's opportunity. So, when everyone's running for the hills is when we should be running in. And if the market is in a situation where it's going to be going, potentially getting softer, providing these opportunities, we want to take advantage. And for other investors, they want to be able to take advantage and make money without having taking a significant amount of risk, then this is a great option. Real estate is something that you should look at. One of the main reasons why today I really suggest people looking at real estate is that in my 30 years, as I mentioned earlier, I'm 54 years old now. And when I got right out of college, I was actually working in the stock market. In fact, believe it or not, I started out as a broker, moved into the trading department. Thank God, knock on wood, I did exceptionally well early on. And you're not going to believe this, but this is back in 1993, 94, 95. As a 24-year-old, I was making $250,000 a year. That's a lot of money back then. And so I thought, and the biggest, that's probably the worst thing that can happen for a 20-year-old. He makes money and he does it quickly. Because then you think your head gets big and you think you're invincible and you think you know everything. Well, let's put it this way. Let's fast forward a little bit. We did that well. I've amassed a little over $1 million in my 20s, invested it into a startup company because we loved, and this is really a passion of mine. As a serial entrepreneur, we love to invest in different projects. I'm basically trying to tell you how I migrated or transitioned from, say, stock investing or private equity and trading into real estate, and why today it is a major staple in my portfolio. I will never go out and tell someone that all of their money should be in real estate. That's not prudent. Number one thing is our objectives are different based on our age, based on our, what our wants and, likes and dislikes are, right? Everyone is different. What fits for me is not going to fit for you. So based on where I'm at my age today, I'm much more risk averse. Back in my 20s, I think I was, that's my personality. We love to take risk. So I loved opportunity. I like the idea that I can invest in something and make it grow 5-10 fold. That I got off on. That was a high for me, as opposed to taking a 9-to-5 job. So going back to when I was in my 20s, I was fortunate enough to do well in trading, made some money, invested into, this is way ahead of its time, invested it into a solar power company, solar power project. So they had these photovoltaic cells with super high efficiency, not as high as what we have today, but at that time, it was the highest efficiency that you can get in these photovoltaic cells. And I felt like, wow, this is the future, because it's renewable energy, especially in third world countries. As you can see, I'm Indian by nationality. I wanted to take this back to my homeland, my motherland, and be able to bring back this technology. The long and short, I invested over $1 million, not knowing anything more, because I've made money was easy coming at the time. I was trading, I was making money. But I lost it because I didn't know any better, and I thought I could participate in private equity. The biggest issue is you're not investing in the company, you're investing in people. That's my lesson number one. Whether you're going to go and invest in a fund or invest in a stock or in a company or wherever you're going to put it in, find out who the people are behind it. Because the concept was great, the technology was amazing, but what I learned out of that whole experience is the people running it were the absolute wrong people. And I should have invested in the people, not the company. Or if I looked at the people more closely, I would not have invested. I would have saved myself $1 million. And when you're 23, 24 years old, 25 years old, that's a lot of money. It basically, I got crushed. Almost felt like I lost everything. The good thing is my grandfather taught me something. They can take away everything, your money, your assets, but they can never take your will and your knowledge. So knock on wood, thankfully, by the time 2001 rolled around and I was getting close to 30, I had amassed a decent amount of wealth again. And at that point in time, we were managing a small fund. It was a trading fund, almost like a hedge fund, where we had like 10x in terms of buying power. September 11th happened. At that time, we had a significant amount of exposure. I personally lost over $2.5 million. And somebody who's 30, 31 years old, $2.5 million at that time, also keep in mind, $2.5 million then is a lot more than $2.5 million today in 2025, 2026. So needless to say, it took a pretty big impact on my life, on my marriage, on my family, etc. we had a kind of, I call it a come to Jesus moment. We had to figure out exactly what we're going to do. I took a year off. But one thing that had never really failed me, if you will, is real estate. Because even as I was trading and other things that I was doing, I always put a little bit of money, as an investment into various different projects. And even though I may not have made a lot, I didn't lose. And the thing I liked about it at the time is after that year I took off from losing a significant amount of money due to the attacks from September 11th in 2001, I took a year off to figure out what I'm going to do. I ended up focusing much more back on real estate. That was '01. Today, we're here at the end of 2025, beginning 2026. And I look back and I thank God for real estate, because it's brought me back to a point where now I have a level that I'm at where I'm comfortable, right? And we're not having to take the kind of risks that we would otherwise have to take to make the kind of money that we want to be able to make. That brings me to, creating this fund, because many of my friends had seen me do this, and they say, hey, Jay, how can we get set up? Where can we invest in real estate where we can actually build a portfolio that's going to provide us cash flow, right? That's going to provide us income so that when we retire, we have something to live on and then be able to leave something behind for our kids, because otherwise we're going to be depleting our assets. And that's when ultimately we ended up setting up this fund. But the learning experience for us is really over the last 25, 30 years. I mean, we've got knocked down twice, had to build it back up, got knocked down again after the attacks in September 11th, built it back up again. And the second time around, I should say the third time around, we've been amassing now real estate. And that real estate, it can depend upon what your personality is. Like, for example, I've done everything from flips, which is a little bit more hands-on, to apartment buildings where we buy an apartment building and we'll do what's called forced appreciation. Essentially what that means is that we're going to update or upgrade the units and then raise rents and then get it fully occupied. So if a property that I might buy for say $2 to $3 million, $2.5, $3 million, after going through this process, we actually see the value of that property climb to $5 or $5.5, $6 million. Significant, right? And that's really done based on, being able to marginally increase that rent. And how will we be able to do that? Because we've updated those units, or we've added other additional revenue sources. Sometimes something simple as just adding a laundry facility to that 100 unit or 200 unit complex is going to add, an extra little bit of income. And remember, the beautiful thing in real estate is a little bit of income actually amounts to a lot of value. And I can explain that more if we want to get into it. But because of the leverage factor, it's huge. And so that allows us to build up that asset. That's maybe not as hands-on because people are willing to be able to manage it and run that for you. So depending upon someone's personality, they can go into flipping, they can go into more passive investing where they just own rental properties. But there's a very stark difference between someone who's a passive real estate investor and someone who's an active or a professional versus a non-professional. You might say, what do I mean by that? So an average real estate investor who invests in property, or if you remember back in 2007, 2008, 2006, when the market was just going up and people would be able to buy condos or put down a deposit on a new construction, and before it's even done, they're able to sell that condo and make a profit, right? Unfortunately, what happens is the rug gets pulled out because, as you know, the market crashed. We had a lot of these bad loans, the real estate market crashes in 08, 09, 10. People got caught holding these condos. So what do? They then rent them out. So they finish it, the building is finished, they're renting them out. They're renting them out, the rent they're getting is not sufficient to cover their mortgage. So it becomes a negative cash flow asset. Now, they convince themselves, hey, at least I'm building equity because over time, this is going to be fully paid off and I'm going to make some money. And it's true, you'll make some money. But when you look at the returns are low single-digit returns. You might be looking at maybe 3%, 4%, 5%, versus if you're a smart investor or a professional real estate investor, you're never going to go into a situation which is a negative cash flow. For me, That's a cardinal rule number one, is I won't invest into a property that's going to basically be dragging me down every month because I have to put money in. I have to support that property. I've got 3 kids. I support them. I don't want to be supporting, 20 other kids or call it properties. So I want to make sure that my property is actually providing positive cash flow, albeit might be small, as long as I know that I'm not having to put money in. So the difference between an active or a professional investor versus a non-professional investor is that many times people will just buy a building or and I, believe it or not, as I'm also licensed, by the way, we didn't discuss this, but I have a managing broker license in real estate. My company, we help people buy, whether it's their first home or an investment property or their retirement home. And we see this happen often. Many people will go in and they want to buy a property because they say, I want to make an investment and I like real estate, but they haven't actually gone through and understood that when you're buying this thing, there's a way to do it where you're not going to be, tied down and having to worry about all the day-to-day. You're not going to have to worry about putting money in every month. So there's ways to structure that. So how do you do that? And that's what we bring to the table. These are the expertise that we put into the PropTech fund. But we taught these people that, number one, you want to buy right. You want to buy it in such a way that you're getting a low enough price. You want to be, if you can, you want to be able to do forced appreciation by updating those units. I have another company that I manage and I own. It's called a flip firm. So what does a flip firm do? In the flip firm, we actually teach people how to find, fund, and flip their property. So first and foremost, how do you find these? We do all kinds of things like tax lien investing, where properties that are either neglected and had not had their taxes paid. We can buy those. We buy foreclosure, short sales. That's the property that I'm living in right now. It's a $4 million house I bought for 2.2. So how do you do that? Because you have to know how to find these properties. It was a short sale property that we're able to acquire, get a great deal on. And now, no matter what happens in the real estate market, I'm protected, because even if the market comes down, there's enough equity cushion built in there. So we teach people how to find it. We teach people how to fund it. We teach people how to fix it and then ultimately flip it. That's one part of my business. We also showed people that we had as clients how to do that. And more importantly, don't just buy real estate that you're buying because you feel like it's a good investment option, because ultimately you're going to end up putting money in every single month. And then what happens is, but the worst thing that can happen is you get a bad taste in your mouth, because now you have that experience. You say, this bloody sucks. I don't want to do this ever again, because you don't want to be dealing with these headaches of whether it's a tenant who calls you up constantly complaining, or you have maintenance issues or any of these things. And that's why many people tend to avoid real estate. They think, oh my God, I'm just going to put money into a stock market. I'll leave it in there and the stock goes up, great. Or maybe more conservative, I'll put money into a mutual fund. I'm a little safer. It's diversified, but at least I don't have to deal with the headaches, right? And so that's one of the reasons why people tend to look, and I completely get it. But if they have another option, such as PropTechs, where you can take advantage of real estate and use the, somebody else's management expertise to diversify your risk away from the stock market, or in conjunction with or in addition to, now you're not having all your eggs or your net worth in one place. You're now having at least 2 horses in the race rather than one. In case something happens to one, at least you got another one that's doing well for you. So this is why I always tell people, look, based on your needs and where you're at, whether you're 30 or 35 or you're 50 or 55, the only thing that changes is your allocation. You may have a greater propensity to take risk when you're in your 20s and 30s, so you have a little higher allocation in that area. But as you get older, if you become more risk averse, like for example myself, at 54, 55 today, my focus has changed, Martin. I don't look at how much money I can make. My number one focus today is how can I preserve what I have. Okay, so preservation of capital is of paramount importance, number one. Number two is, will that capital that I have provide me the income that I need to be able to sustain the lifestyle that I have, whether I'm 55 or 65 or 75, et cetera. And third, and I wouldn't say last but not least, but equally important is, will I be able to have enough that I can leave behind, where it will not get lost in probate taxes should something happen to me? So it has to be done in a proper structure or in a proper investment vehicle that, should something ever happen, it goes either into a trust or my kids will have it and they're protected. I'm leaving more for them rather than letting Uncle Sam take a huge chunk in taxes. So these are some of the things that we focus on. I've been fortunate, knock on wood, because we were first generation um, immigrants. We're from India. I credit my parents with. I mean, they came here, they had nothing except for one thing, which is the will to work hard. And that's why even today, if you look, and I'm really proud of my heritage and the culture because the Indian population in America today is the highest per capita income earning group that exists in the country. And if you think about it, that's pretty incredible considering, everyone that came here really came with nothing. So these are all mostly self-made or, done through either education and or hard work. So it's a testament to the group and immigrants in general, because when they come here, they don't have anything. You got to work their butt off. So we were taught when we were young how to, save money, flip coupons every week for groceries, work our butt off, get an education so that hopefully we can provide something more to our kids than what we had. Although looking back, I'm extremely thankful because had we not had that upbringing, we wouldn't have, the foundation that we have today. This business that we built is not just myself and my kids are participating. My wife, who's actually a pharmacist by education, has a doctorate, has now left her job, her position at the hospital, where she's been in I think at that hospital she was there for 15 years, and in the industry for over 25 years, and now has joined us in real estate. And what does she bring to the table? Well, one thing that we didn't really talk about, and where we feel that we can really benefit the community and what we do, is, and I'm going to tell you something, is that part of it is in a selfish interest. I'll be completely transparent because it's going to make us a lot of money. But the second part of it is that we feel providing something that there's a significant lack of in the market. And that is, we're now focusing significantly on assisted living homes. And that's a part of, what I know in terms of real estate is that I know I want to put my capital, and even the fund does the same thing, is that we put our capital into assets that we know, number one, will appreciate, and two, that we can get a decent income from. But more importantly, also, what is it that we're contributing to society and how are we helping? And one of the things that we learned in part of our research is that today there's a shortage of over 1 million beds per year and you say, what is that? What does that mean? This is basically the baby boomers. As they're coming of age of 7 to 75, 80 plus, we're just there at the tipping point. And as they're coming of age, they need care, and they need care from, I'm not talking about a senior home per se, where you have doctors and nurses, but I'm talking about there are many people that just need help, maybe getting dressed, maybe getting fed, maybe, or it's possible that a couple, one of the spouses has passed and now they're living alone. And, it's a proven fact that if you have more social interaction, you have friends that you are around, you live a healthier and happier, overall happier life. So people are looking at turning more towards the type of, call it like almost like a group home. So what we're doing is we're building what are called residential assisted living centers. And my wife, who's a pharmacist, we don't necessarily need to have licensed doctors and nurses, but you do need somebody who's going to be helping administer with the medicines to make sure that the tenants or the guests or people that are staying there are getting the proper medication when they're supposed to get it. And they oversee the caregivers who are providing it to make sure that they're educated, they know what to provide when. But the point I'm making on a bigger level is this. Today, there's a major shortage because these people that are getting to that age, 75, 80, 80 plus, many of them will require some sort of assistance. And the other thing that happens is dementia, Alzheimer's. So there's something called memory care. And most of the big boxes, there are companies that are out there today and by the way, they're doing exceptionally well if you look at their overall returns and income, et cetera. But the problem is the type of care that they're getting is just it's not there because they have one employee for every 30 individuals living in that home, right? So you have 300 or 200 people, and you might have maybe, 10, 20, 30, et cetera, 15, 20 employees, but they're not getting the kind of individual care that they would need. So for example, they all have this little buzzer, they can buzz on it, but we've seen that they don't get the attention for as much as an hour or even 2 hours or longer. In the facilities that we're building, we only have one person for every 4. Now you've got much greater attention. And I know as as someone who has 2 thankfully living parents, my wife also has 2 living parents. If and when they need care, I don't want to put them in a big box where they're going to be neglected. Because one, I have the means, and thankfully, even they would have the means that they can go into one of these facilities and they're going to get a better level of care. So we're doing it for them from that perspective. Now let's look at the economic side of it. From the economic perspective, and I said before, is that selfishly, yeah, it's actually an extremely good investment. The average person that stays in these homes is paying between $6,000 to $7,000 per month per individual. And that's average. Now, if you look at the better quality ones, they're anywhere from $8,000 to $10,000 per person per month. I'm not talking about for the year, per month. So when you look at the numbers on these, and memory care, by the way, is even more than that. Memory care, the numbers go up as high as $10,000 to $12,000 per month because they require greater attention and just overall more care. So $10,000 to $12,000 per month per individual. And these homes, let's say, for example, you've got 12 rooms. Each person gets their own individual room. And let's assume they're paying an average of $10,000. That's $120,000 per month that facility is generating. And your cost of operation, even after taking out, let's assume $20,000 for the property itself, another $40,000 for payroll, you're at 60, another 10, maybe 15,000 for food and everything. You're only up to about $60,000, $75,000, and you're generating $120,000 in gross. So you see positive, strong cash flow, $30,000 plus per month in positive cash flow. It's a great investment, and we're taking a lot of that money and putting it right back into incredible programs, tremendous, assistance for them. And it's good because I know I have parents, as I said, my parents are both 80 plus. My wife's parents are both 80 plus. So, we only know what we see, right? And what we're around, what affects our lives. So as we've seen this and saw that, hey, how can we take what we know from real estate and how can we make a difference? So this is one way that we're not only making a difference, but at the same time, being able to make a decent amount of income. And now what we've done is we've built that into our PropTech funds, because in the fund, we have 3 different verticals that we invest in. So one of those, we talked about it, is basically buying distressed properties, foreclosure, short sales, etc. Another one is building or, setting up these type of facilities. Now, the important stipulation or the understanding is that PropTech is not in the business of investing in businesses. PropTech invests in real estate. So what we are essentially owners of assets, of hard, tangible, physical properties. We own the property, we're the landlord. We're not going to be in the business of running that business. But what we do get as a result of building these is we get really much higher, above average rents than someone would get if they were to go ahead and try to do it on their own. Because why? We're giving them speed, right? We're going out and setting, first of all, spending the money. So we build it with our own capital. Number 2, it's turnkey. So someone who wants to run that business, so we can actually set it up and sell it to them, or they would rent it from us and they run the business. We make money because we're getting for the property as well as the business. So it's a great setup for both the fund as well as for us. For us, it's great because now we're giving back. And should the time ever arise when either my mother or my father or my in-laws need that, we have properties that can accommodate, as well as my friends. So we've actually had friends that have now put their parents into these, and they love it, by the way. So, you say, traditionally, our society in the Indian culture is very different. So today, even my parents live with me, right? That's just how we are. We're close-knit families. And that's how it is. Traditionally, they live together. But as they get older and then there's more care required, it's hard for me to be able to provide it. It's not only a matter of economics. I may have the funds, and unfortunately, not everybody has that capability. We are lucky that we have that. But do I have the time? Do I have the ability? Do I have the expertise? Those are things I don't have. So I want to make sure that if I'm going to look after my parents, I want to have them have the best care and in the best environment where they're going to thrive, they're going to enjoy those golden years. So this is something that we've built, and we're really proud of it. That this is something that one way for us to give back. Other things we've done in the past that we love to do is, whereas at my old company we had when I was over at KW, we had Red Day, which is the day we just we go out and we build. You probably heard what is the name of that? I can't remember. Where basically you're building homes or going in there to help build homes for people that are less fortunate, or maybe someone who may have lost a home to a fire or something like that. Today, I rest my license over at EXP, and we do the same thing. We contribute a nice little percentage of everything we generate. Because at the end of the day, what is life? We're lucky that we have what we have. But our policy is always, in one way or another, to give 10% back in one way, shape, or form, so that we're able to help. And that's what we teach our kids: pay it forward. If someone is thinking about retirement, because I know a lot of my friends, you go at a cocktail party or a dinner with friends, conversations come up. And sometimes you might talk sports, sometimes you talk politics. Unfortunately, nowadays, a lot of people talking politics here in this country. But undoubtedly, the topic of, retirement comes up, and travel and things like that. And you'd be surprised, but many of my friends have actually been in that same boat where they're saying, hey, listen, Jay, how do we get set up in a situation like what you have? So I tell them, look, if I would tell your listeners the same thing, Martin. If someone's interested and they want to learn more as far as, what is it that we do, how do we do it? If they want to just do their own research, they can go to the website. It's proptex, proptex.com. If they want to personally speak with me, because I believe in really interacting and getting to know my clients and or investors. I don't want you to have to talk to a salesperson. We're not so big that, we're going to put layers between us and them. All of my clients, investors, have my mobile number. They're welcome to call me. But if you go on to our site, there's a little form you can fill out. You can just say, look, I'm interested. And there's like a drop down. You can choose whatever you're interested in. And that message will ultimately come to me, and we will set up a call. You'll get my link to my calendar, and you can open it up and set up a time that works for you. But ideally, this is really about understanding where you're at and where you want to be. If you're someone who's in their 40s or 50s, or potentially, let's say, even in their 60s, and you're looking at, I have X amount of dollars that I've saved up. It's in my 401k, or it's in my, IRA, or whatever. Maybe it's my stock option plan that I've got, or, that I'm getting from the company as a nice package when I leave. What am I going to do with that? And you're great at what you do, and it's a testament to what you build. But you're not great. And we all have our positives and our strengths and our weaknesses, right? I have my weaknesses and I know what they are. What I do when I have my weaknesses, I don't try to pretend that I know what I'm doing. I go find an expert that does. And that's one of the reasons why we've been able to get to where we are, because I've made the mistakes, right? We've lost tons of money. As I gave you examples earlier, I was 23, 24, thought I knew everything, and I lost $1 million. Again, I built it up and I lost over $2.5 million in 2001 when the attacks happened. We've made mistakes, and these are just a couple of examples. And the other thing we learn is, unfortunately, we learn our biggest and our most valuable lessons from our losses. And I can tell you that I've had plenty of those. So one thing I've learned is, when it comes to things that you don't understand, don't try to fake it, and find someone that is an expert and talk to them, educate yourself before you take a step. As I said before, really get to know the people you're investing in, because it's not the product, it's the person. So if you believe in that person, you understand, and you can see that they can deliver you, then make an investment into that individual or that person, whether it's this fund or any other fund. But what we're here set up for is simple. If somebody were to take a look at my example, that I'm 55, let's say I was looking at retirement and I only had hypothetically $500,000. If I combined all of my assets and I had $500,000, What would I do with that? Well, I'll tell you. Now, knowing what I know, what I would do is I would take that and see if I can put it into an investment that's going to provide me capital preservation. Number one, I cannot afford to lose that because this is money that I need to live on, right? So I need to find an investment that's going to give me capital preservation and security. Number two, I should be able to maximize whatever I can. Traditionally, the greater the risk, the greater the return. So you have to keep that in mind. You don't want to go after something that's going to be, you're going to look for a higher return because that means you're going to have to take a higher degree of risk. And that's going to conflict with our number one goal, which is capital preservation. So once you have your cut, you know that, okay, I want to preserve my capital. Where am I going to get my best return? What I tell people is absolutely consider real estate. And then if you decide and you understand that, hey, real estate is good for you, but it doesn't work for my situation based on timing and I don't have the time to put in to manage it, then look into people that can help you manage it, or a fund, like a real estate fund like PropTex, because PropTex can deliver you 11% per year. Now, it doesn't sound sexy or exciting, but look, at the end of the day, we're at a point where preservation is more important than profit. So 11% is still nothing to balk at. Why do I say that? Because if you look at the S&P 500 over 10, 20, or 30 years, the average return on the S&P, this is the S&P 500, the top 500 companies, is only 9 to 10% per year. So if you're getting 11% without the level of risk of putting it into the market and it's backed by real estate, furthermore, knowing that the manager, Jay Patel and his team, will not make a dime until you make your 11% first, it'll give you a little greater comfort level knowing that there's a better chance of getting my 11% per year. Another point that somebody had asked me recently, hey, Jay, so if I make 11% this year, but for some reason something happens and I only get 10% next year, does that mean that in the third year, if you make 11%, you guys get? No, the way it's structured today, it's a cumulative 11%, which means that in year number one, if you make 11% for any reason, if you only get 10 in year number two, then year number three, I have to deliver you 12% before we as the management team earn anything. So, you should be, and again, as I said before, the properties that we're buying these foreclosures and short sales at 20, 25% minimum below market value. We're also doing forced appreciation. I gave you another example of these assisted living centers. Another example we do is we buy a lot of tax lien, tax deed type properties. We're buying these on pennies on the dollar, fixing them up. But our average return on these transactions are between 20 to 25%. So there's enough of a cushion. Some are even higher than that. There's enough of a cushion where we know we're able to deliver you 11% consistently and still be able to cover all of our costs and make money for ourselves. So I would say, if somebody's interested in that boat in their 40s, 50s, 60s, and they're looking at being able to build a solid plan for retirement, maybe consider allocating a piece. And I would never say put everything in there, but consider allocating a piece of your investment into something like PropTex.
21st Century Entrepreneurship with Martin Piskarik.
Imagine a space where triumphs, trials, and tales of entrepreneurship come alive. Welcome to the 21st Century Entrepreneurship Podcast, a gold awarded journey hosted by Martin Piskarik, connecting with listeners in 95 countries and ranking in the top 0.5% of all podcasts. Join our exclusive community, elevate your perspective, and embark on the path to success.